higher yields on that debt means that as the governments want to borrow money, and the gilt market, the treasury market, that is where they borrow their money. If they're having to pay higher rates of interest, it's essentially it's money which is then going to have to be paid back over very long periods. It's going to be the generations that follow that will be basically paying tax in order to pay those bondholders out in the future. That means less money for public spending, basically. And so you're kind of mortgaging the future slightly by paying these higher interest rates now. Hello, everybody, and welcome back to the Personal Investor Podcast. I'm Ed Monk, and I'm joined once again by Tom Stevenson, Investment Director here at Fidelity, to ask what is rumbling in the bond markets that is getting some economists and market watchers worried. The prices of certain government bonds have been falling. Why is that? What is it telling us? And why might this be good news for those in or nearly in retirement? Before we get into that, could I just encourage everybody to subscribe to this channel, to like the video, to join the discussion in the comments if you like. It really does help other people find this content, and it means you're going to get new content as it is released. That all said, Tom, welcome along. We're going to try and unpack all of those questions that I laid out there in my introduction. But let's start with a few basics, because we're talking about the bond market here, and I always think there's a little less understanding of that than there might be about the stock markets, which we often talk about. Which bit of the bond market in particular is flashing red at the moment?
Yeah, so what we're talking about here is long bonds, and what that means is the bonds which are issued by governments in particular, rather than companies, and the bonds which are issued for a long period of time. So we're talking really about 30-year bonds. So governments issue bonds with different maturities, anything from a couple of years all the way up to 30 or 50 years. And what the maturity means is that is when the issuer, the government in this case, promises to repay the capital which you have lent to the government. So the issue that we're talking about here is principally about these longer 30-year bonds.
30-year bonds. And I was going to say, when people talk about prices in the bond markets, they tend to talk about the yields. Is that fair to say? And the higher the yield on a bond, the lower the prices become, right?
Yeah, so the yield on a bond is the inverse really of the price. So as the yield goes up, then the price goes down, and as the yield goes down, the price goes up.
Yeah, and we needn't get into it, but it's because there's a fixed income being paid, and investors, if they demand a higher return, that means a lower price basically, and that's that mechanism there. So these are long dated bonds, meaning they mature a long time into the future, several decades. They've been falling in price. The yield has been getting higher. So why is that? Why are yields rising there in that bit of the market and not on shorter dated bonds, 2-year bonds, to say? Why have they been generally falling this year?
Well, the different maturities of bonds, it's not just a matter of when they're going to be repaid. Because of the different length of time until they're repaid, they are impacted by different factors. So if you are investing in a short-dated bond, for example, you know that you're going to get your money back, let's say in 2 years' time. You're actually not that fussed about what the outlook is for inflation, because in 2 years, there isn't going to be a huge amount of time for inflation to take effect. If you're investing for 30 years, however, inflation actually becomes a very significant factor, because the thing about a bond is it pays a fixed income. The income doesn't rise in line with prices, it's fixed. So if there's a high rate of inflation over that 30-year period, then the value to you of that income diminishes over time. So long-dated bonds are particularly sensitive to what's happening in inflation. They're also sensitive to the possibility that the capital will not be repaid to you in the end. So the reliability of the trustworthiness of the issuer of the bond, and clearly in the short term, there's relatively little risk because you can see, what's going on with the government, for example, over a 30-year period. Then all sorts of things can happen over 30 years. I mean, we have little insight into what the world's going to look like in 30 years' time. So therefore, the risks are different for a long bond than a short one.
And so is that what is happening now? Is that the calculation that the market is making about these longer dated government bonds? We're going to talk about gilts. Those are the government bonds issued by the UK government. We might talk about treasuries. They're the government bonds issued by the US government. Is the market then, is it worried about inflation over the long term? Are there other factors that are pushing the price down and the yields up on those bonds in particular?
Well, so the market is increasingly worried about inflation. Inflation has proved particularly sticky, and the market is concerned that various policies around the world, whether that's the tariff policy in the US, for example, or other factors, is keeping inflation persistently high. It's also, though, concerned about just the sheer level of government spending around the world. Governments have spent increasing amounts. They spent a lot of money after the financial crisis to boost the economy. They spent a lot of money during the COVID crisis to boost the economy. Problem with spending money is it tends not to get reversed. Once a government, or particularly a population, gets used to a high level of spending, they want it to continue. And so it's quite difficult for governments to cut spending. We saw this in the UK recently when there was an attempt to cut welfare spending. And the backbench Labour MPs just made it absolutely clear that this was not a cut that they were willing to countenance. Of course, the reason they weren't willing to countenance it was the people that vote for them are not willing to countenance it. So I think that the fear is that government spending has risen and is going to stay high almost in perpetuity. In order to do that, governments need to issue a lot of bonds. If you issue a lot of bonds, the supply increases. And if the demand doesn't increase to match that higher supply, then you get a mismatch. And that's what pushes the yields higher.
Yeah, we're going to come on and to look at the specific examples of the UK and the US a little bit in a moment. But is it then straightforward in the sense, as you say, of supply and demand? The market is saying, we think you're going to have to issue a lot of bonds in the future to meet the spending that you've committed to. And that, by the way, we think you're going to find it very hard to reverse. So we expect that supply to be there. And it's also true that because of the unwinding of quantitative easing and lots of bond buying that had happened in the last 15, 20 years, that means there's less demand out there. And someone owning government bonds at the moment says, well, do you know what? I think those yields are going to be higher. They're going to have to be higher in the future. You're going to have to meet those higher demands for yield. And so I'm going to sell my bonds now. I'm going to wait for the yield to rise and buy them again in the future. And that's basically the equation. That's the calculation that the market is making.
Yeah, and there are a lot of moving parts to this calculation. I mean, you're right to point out it's not just about government spending. That supply-demand balance is affected by other things. And one of the factors is that for much of the last 15 years or so since the financial crisis, many government bonds have been bought by central banks. This is a quantitative easing that you talked about. That process is now going into reverse. Central banks are selling their bonds back into the market. At the same time, one of the key buyers of long-dated government bonds, pension funds, has disappeared from the scene. Well, disappeared from the scene, but they are less keen to buy long-dated bonds than they used to be because the final salary pension schemes are being wound down, and the pension schemes were avid buyers of long-dated bonds because they enabled them to balance their long-term liabilities with their long-term assets. They no longer need those long-term assets in the way that they did 5 or 10 years ago. So you've got more supply coming on, you've got less demand, and the net result is that the governments have to pay a higher yield in order to persuade investors to take up the slack.
Yeah, I just wanted to return slightly to a point you made around the levels of borrowing, because this is a global issue. We're going to talk about the UK, and it's become a bit of a a particular sore point in the UK, but I was reading a statistic that said if you looked at the average debt to GDP of OECD nations, so the big leading economies essentially, in 2007, and I suspect prior to the credit crunch in 2007, it was something like 70% as an average. And now that average, all these years later, is 110%.
Yeah.
I think. So, the financial crisis definitely part of that. The pandemic definitely part of that. Increased spending on, look what the UK government has done on, energy price guarantees these last few years to combat the cost of living crisis. All these things and versions of them have been happening globally. And there's a bit of a moment where the bond market is sort of alive to that.
Yeah, and it is, you're absolutely right. It's not just a UK issue. I mean, you only have to look at what's going on in France at the moment. I mean, the government has fallen on the back of a crisis of tax and spend. They are finding it almost impossible to push through the spending cuts that they require to balance the books. And you mentioned that 110%. I mean, I think that the debt to GDP ratio of others is actually a little bit above that. But as recently as 2017, it was well below 100%. Exactly the same thing is happening in America, and it's part of this whole sort of shift in politics in a more populist direction. Populist leaders, they want to reduce taxes and they want to increase spending. Why? Because that's what people want.
Yeah.
That's our ideal. Pay less tax and have fantastic public services. The reality is that it doesn't work. But that has been the shift in politics all around the world. And it's very difficult to reverse.
And it means, or higher yields on that debt means that as the governments want to borrow money, and the gilt market, the treasury market, that is where they borrow their money. If they're having to pay higher rates of interest, it's essentially, it's money which is then going to have to be paid back over very long periods. It's going to be the generations that follow that will be basically paying tax in order to pay those bondholders out in the future. That means less money for public spending, basically. And so you're kind of mortgaging the future slightly by paying these higher interest rates now.
And the danger is, of course, that you find yourself in a kind of doom loop where governments are spending more on the interest on their outstanding debts. That means they have less money to invest in growing the economy. People have less money because their mortgages are higher, the cost of running businesses is higher, so they have less money to spend. So therefore, the economy doesn't grow as fast as it should. Tax revenues decrease, so therefore the government has to borrow more, and you get this circular doom loop, which is another thing that that bond investors are concerned about, because I think if we get into that loop, then the government is just going to issue more and more bonds, and we're never going to get out of it.
Yeah, well, we're going to come on to where it might go in the future. But spending some time on the UK, people will be familiar and will remember well the mini budget. That was something that happened in October 2022. A big budget of higher spending and tax cuts, essentially. Which the bond market did not like at all, and the yields back then on 30-year UK government bonds rose very quickly and high and to a high level. The level today of those bonds is above that level, which is why there's a lot of alarm. It's not quite the whole story, is it? Because the rise back then was much more was from a lower base and was much more sudden. And then the rise in the last year or so has been sort of more gradual and has tracked the general rise in global bond yields, it said as well. But what are the particular challenges in the UK around this issue?
Well, I mean, the challenges are the same old challenges, which is that the government is committed to a high level of spending. It is difficult for it to raise taxes enough to pay for that high level of spending. One of the reasons why it's difficult for the government to raise taxes is in order to get elected just over a year ago, the Labour government made some promises about taxation. It said that it would not raise income tax or VAT or national insurance.
Which are the
on
big
working
ones,
people.
basically.
Well,
They're the ones that
the
raise
problem
lots of
is
money.
that they raise around half of all tax revenue. So if you take those off the table and say we're not going to touch those, it makes it very difficult to raise other taxes in order to do that, and and it means that you have to raise those other taxes by relatively more. I mean, if you were to say, look, okay, let's have an adult conversation about this. You want good quality public services, you have to pay more tax. So therefore, you're not going to pay 20%, 20 pence in the pound on your basic rate of income tax. You're going to have to pay 22 pence in the pound. That would be a sort of adult thing, and we're all going to share the pain. But because that was taken off the table, and because, if you like, the sort of DNA of the government is to target wealthier people, then the kinds of taxes which they are speculated to be targeting are things like capital gains tax, inheritance tax, property taxes, maybe wealth taxes, which impact a smaller number of people, but a wealthier kind of people. So that's the challenge we face at the moment. Running up, and of course we've got a budget coming up in about 10 weeks' time, when all of this is going to, the tire's going to hit the road.
Yeah, and lots of tax rises have been ruled out. Some have been effectively ruled out, I would say, as well, because the government needs growth, and they don't want to tax companies too much more. They imposed extended national insurance to employer contributions for or national insurance on the employer contributions, and the jury's out. Maybe that's a generous way of putting it, and on whether or not that tax rise has worked.
Yes, I mean, I'd say the jury is not out on that. I would say that the government was elected on a ticket of targeting growth in the economy, because ultimately the only way really to escape this doom loop that I talked about is to generate growth. To generate growth in the economy, that generates more tax revenues, that enables you to fund spending. Maybe there's a bit of inflation that erodes the level of your debts. That's a positive way of growing out of the problem. Almost the first thing that happened, though, was that, and to be fair to the government, they did inherit a lot of these issues. There was a gap between spending and tax revenues which needed to be filled. And at the last budget a year ago, the way in which the Chancellor chose to do it was by levying a tax on companies. And the thinking there was, we're not going to levy a tax on working people. We're going to levy it on companies. Now it's a moot point whether they're actually different, because arguably, what is a company? It's a bunch of people that work for that company. If you're levying a tax on the company, you're really levying a tax on people that work for it. And the consequence of that, I think, is slower growth than would have been the case. Companies are raising prices. They're cutting their workforces. That is not a growth agenda.
Yeah. You mentioned we've got a budget coming up. We have a date for that, 26th of November. And there is, I can't remember actually the predictions of tax rises being as firm as they seem to be in the moment. People seem very, very, very sure that we have no other choice but to raise taxes very severely. Time will tell. We will see about that. Looking at the past year, it really has been a whole series of events that have kind of made this problem worse. That first budget a year ago, it was interesting. We covered it. It was really, budgets are always like this, but that was particularly a budget where the story was actually in the numbers. It wasn't in the headlines. And I don't think the headlines did a very good job of covering all that budget was about, which was a huge, big extra boost injection into the NHS, with some tax rises to pay for that, but actually lots and lots of borrowing to pay for that as well. That's actually the story. So the fiscal position got slightly harder and tighter from that point of view. growth has not been great. It's been it's sort of bumped along, isn't it, in the past year? And actually, some signs that it might get better, but it hasn't been great. And then, as you say, every time the government has tried to cut spending on targets for cuts, which possibly aren't that or shouldn't be that contentious,
No.
they found it impossible to do. Yeah, and their own party won't let them do it. Facing a hell of a lot of opposition around the words fuel allowance, around disability cuts, and obviously those are all political issues that are worthy of discussion. But the government tried to do it, hasn't been able to do it. So this reaction from the bond market isn't necessarily surprising.
And the one thing that you haven't mentioned there is that normally a government, a chancellor, will leave themselves a bit of wriggle room. They'll create what the economists call headroom. So it's a bit of a cushion between what they need to raise in taxes and what they want to spend in spending. And at the budget last year, the Chancellor chose or didn't really have any choice, only left a tiny bit of headroom. And that's what the bond market is looking at. They're worried that it's quite easy for that headroom to just disappear with slightly lower growth, slightly lower tax revenues, inability to push through spending cuts that you thought that you were going to be able to. And of course, that's what's happened. And so now that sort of, people call it a black hole. It's not really a black hole, but that's widened, and that's why there is this, almost unanimity about the need for tax rises. There are only two things you can do. You can raise taxes or you can cut spending. If you can't cut spending, you have to raise taxes.
Yes, and that's where we come to, where this all comes to a head and sort of how sort of dramatically it does so. Both those things, tax rises, spending cuts, have the potential to slow down growth. That will obviously, all the negative consequences that come with that, less job security, less wage rises, potentially people getting poorer in real terms, potentially. And also it has that potential to harm the stock market in the longer term as well. Again, this is not just a UK issue. I will just briefly mention the US, where Treasury yields rose recently because actually a court case threatens to block some tariffs. And the bond market said, well, actually, the government now needs that tariff revenue that Donald Trump is delivering. It needs it. Otherwise, the government's going to have to borrow more. So there's all sorts of different parts of the world where this is showing up.
Yeah, absolutely. And I mean, the whole tariff is a whole topic in itself. But I mean, what's one of the interesting things that's happened this year is I think that the whole narrative about tariffs has actually changed a bit. I mean, back in April, we were very worried about tariffs, about how they would fuel inflation and they would slow growth. Actually, I think people are more relaxed about tariffs. And one of the reasons they're more relaxed is actually they are genuinely raising a lot of tax revenue for the US government. So, that is going some way to paying for this, this fiscal spending that the US government seems, unable to stop doing.
Well, spending and tax cuts.
Yeah, and tax cuts. Absolutely right. So the idea that the tariffs might not be legal was taken actually badly by. So having not liked tariffs, now the media seems to like tariffs.
Yeah. Okay. A lot of negativity so far, Tom. Let's look at some silver lining, shall we? I did say that there was one group of people who are well placed to win in all of this, and that is anyone about to buy an annuity. And why is that, Tom?
Well, the reason is that the rate of return on an annuity is tied to the bond market, to bond yields, and in particular, I think it's a sort of middling maturity bond yields, about a 15-year bond yields. So as bond yields rise, all other things being equal, the amount of money that you could expect if you buy an annuity goes up. And currently, annuity rates are really very attractive. So if you are, if you're in the position of moving into retirement, or even you may even be partway through retirement. Let's say you're in your get, because the older you are, the
Better rate
better
you
rate you get. So
Yeah.
I mean, let's say you're coming up to your 70s. The annuity rates that you can get today are really extremely attractive.
Yeah. The person I think has had the best of this is probably the person around 75, where they've actually had a brilliant run last 10 years or so in some markets, really good run actually. And then now they're probably slowing down anyway, probably looking at ways in which they can kind of secure their spending, or secure their income, I should say. Annuity rates are great for that kind of person, don't they? Because they're going to be really, really, really healthy historically, or high by historical standards.
And they built up a decent amount of capital in order to purchase that annuity. Yes, they may not even need to use all their capital to get the level of income they require, and so they can have the best of both worlds. They can have, a bit of ongoing exposure to the stock market and the inflation protection that provides, and also buy an annuity as well, part of it.
Okay. Well, Tom, that is just about all the time we have for now. I will just remind you all that if you found this useful or interesting, so please subscribe to the channel. It means you'll get updated content as soon as it is released. Give us a like or share the episodes. It really will help people find what we're doing here. That said, Tom, thanks for joining me.
Thanks, Ed.